Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
Hey guys, welcome to the channel. My name is Travis, and if you're new around here, I like talking about investing or anything to do with building wealth. If you want to hear more about topics like these, make sure to subscribe. It doesn't cost you anything, and if I say anything dumb during the video, you can always unsub at the end. So today I wanted to talk about the best growth ETFs to hold on to for the long term. A huge portion of my portfolio is made up of growth ETFs, and specifically some of the ETFs that I'm going to be talking about in this video. So really quick, just in case you don't know what an ETF is, buying an ETF is the equivalent of buying hundreds of stocks all in one. This is useful because it mitigates your risk. If one of the companies fails, it doesn't matter because the rest of the companies will continue to grow. This is why most ETFs are considered very low risk and completely passive investments. So then you may be asking, what is a growth ETF? A growth ETF is simply a fund that invests in companies that are considered to be growing at a very rapid pace. So now that I've got that out of the way, how did I make this video? Well, to start, I looked through so many ETFs. I was looking at things like growth rate, holdings, industries, expense ratio, dividend, turnover, and basically anything else that I could find. Additionally, I watched a ton of best growth ETFs here on YouTube, and I truly believe that this list includes some of the best out there. This list includes 4 of the top growth ETFs that I could find, and at the very end, I'll talk about which one takes my top pick. That is, if you forced me to choose just one. Also, one more thing before I get started. There are a lot of funds out there that you'll see, and they're typically thematic funds, that have returns of like 80%, 100%, 200% in just 1 year. Well, typically these funds are just simply not sustainable and are just a one-hit wonder. I refuse to give what I know is bad financial advice, so I've not included any of those on this list. Now, let's jump into it. The first fund on this list is the Vanguard Growth Etf, ticker VUG. This fund makes up a huge portion of my personal portfolio, specifically my Roth. This fund seeks to track the CRSP Large Cap Growth Index, which classifies growth stocks based on a number of financial factors. This fund tends to focus more on earnings than it does revenue compared to the other funds on this list. It has an average annual appreciation rate of 16.7% over the last 10 years. This is actually the lowest average return out of all of the funds on this list, but this is still a really high return with a very long track record. One of the best parts about this fund is that it has an expense ratio of just 0.04%. Just in case you don't know what this means, this is just simply how much you're charged each year for owning the fund. Meaning every year they're going to come in and take 0.04% of what you own in that fund. Its top 10 holdings include Apple, Microsoft, Amazon, Facebook, Google, Tesla, Visa, Nvidia, and the Home Depot, which all make up approximately 45% of the fund. Its top 3 industries are technology, consumer cyclical, and communication. These industries make up 72% of the fund. Obviously, most growth-focused ETFs are going to be very heavy on technology. If for some reason you're looking for a fund that's even more heavy on tech, I would check out Vanguard's VGT. The second fund on this list is Investco's QQQ, commonly known as the Qs. This fund seeks to track a modified version of the NASDAQ 100. It invests in the largest non-financial companies within the index. And again, no surprise to anyone, this fund skews heavily towards tech. This is a fund that I've personally held on to for over 4 years now. It's had an average annual appreciation rate of 20% over the last 10 years. This is an absolutely incredible growth rate considering that it happened over a span of 10 years. There are very few funds out there that have averaged a return that high for that long. Even if you include its performance during the dot-com bubble, a time when most internet and technology companies were going bankrupt, it still had an average annual rate of return of 9%. On top of all this, the expense ratio of this fund is a little bit higher, but still a very manageable 0.2%. Its top 10 holdings include Apple, Microsoft, Amazon, Tesla, Google, Facebook, Nvidia, PayPal, and Comcast, which make up approximately 53% of the fund. But one thing that I don't like about this fund is that its top 3 holdings make up approximately 30% of the fund. Those 3 holdings are Apple, Microsoft, and Amazon. Its top 3 industries are technology, communication, and consumer cyclical. These industries make up 82% of the fund. I think this is an absolutely incredible fund, and considering that I own it, I obviously endorse it. So the next fund on this list is extremely famous, and I would argue it's probably the most well-known fund on the internet. And of course, I'm talking about ARK Invest's ARKK. This fund has the potential for very high returns and has absolutely killed it over the last 6 years. But for reasons I'm going to explain in a second, it's actually my least favorite fund on this list. ARKK is an actively managed fund that seeks to invest in disruptive innovation that they believe has the potential to change the world. It's led by the acclaimed fund manager, Cathie Wood. It's had an average annual appreciation rate of 47% over the last 5 years. This is a relatively new fund, so its track record isn't very long. These type of returns are absolutely insane and extremely uncommon. If I'm honest, I would be shocked if they're able to keep up this rate of return over the long term, but I do expect it to continue to grow at a pretty rapid pace. Its top 10 holdings include Tesla, Teladoc, Roku, Square, Shopify, Zillow, Zoom, Spotify, Baidu, and Exact Sciences. These holdings make up approximately 47% of the fund. Its top industries include healthcare, communication, and technology, and these industries make up approximately 82% of the fund. For what I would personally describe as a thematic fund, it's pretty well diversified, which I personally like. So why do I say that this is my least favorite fund on this list? Well, to start, studies have repeatedly shown that throughout history, there are very few actively managed funds that outperform the market over the long term. If you don't know what an actively managed fund is, this just simply means that there is a professional that is actively changing the holdings within the fund. The goal of this is to obviously outperform the market, which ironically enough, rarely happens. According to a study released in 2018, over a 15-year time horizon, 92% of large cap managers, 95% of mid cap managers, and 97% of small cap managers fail to outperform their index. Even when managers do have short-term success, rarely are they able to repeat that success. Meaning if you invest in ARK right now, you're investing into an actively managed fund that has been significantly outperforming the market for the last 6 years. I'm not saying don't invest in this fund. There's a reason why I included it on this list, but I'm just making sure that you guys are aware of what situation you're getting into. To make things worse, actively managed funds typically have really high fees. In ARK's case, it has a whopping 0.75% expense ratio. Over the course of 30 years, that will add up. And one more thing before I move on. Companies that don't focus on cash flow at all and are purely focused on cash flow in the future are more negatively affected by rising interest rates than those that do. A lot of the companies within ARK funds are purely focused on innovation, and because of this, a lot of them are barely making a profit or even running at a loss. So if you invest in this fund, be prepared for short-term losses if the Fed ends up increasing interest rates. Again, I do think that this is an amazing fund, but I do think that these are things that you should be aware of. Okay, so the fourth and final fund on this list is O-Shares Global Internet Giants ETF, ticker OGIG. Just so you know, I personally own a decent amount of this fund. This fund seeks to invest in quality technology companies that will benefit from the digitization of the global economy. The fund also prioritizes high revenue growth, and this is evident with the portfolio average being at 40% a year. If you compare this growth to other common indexes, you'll realize that this growth is absolutely massive. The fund has had an average annual appreciation rate of 28% over the last 3 years. This is one of the downsides to this fund. It has a very short track record and was recently founded in 2018. Also, despite this fund being passively managed, it has a pretty high expense ratio of 0.48%, meaning Kevin O'Leary is taking a lot of your money. Its top 10 holdings include Amazon, Google, Tencent, Microsoft, Alibaba, Facebook, Meituan, Pinduoduo, Snap, and Delivery Hero, which make up 33% of the fund. This is a relatively low number, meaning no individual holding holds too much weight. On top of that, I absolutely love these companies. The top 8 picks were basically picked out of the mind of Travis. 100% of this fund is made up of 3 industries: communication, technology, and consumer cyclical. In case you can't tell, even though this fund doesn't have a very long track record, I love this fund, especially because it's focused on revenue growth rather than profit. And according to research, considering that 74% of long-term stock performance is driven by revenue growth, I really don't think that this is a bad thing. But again, keep in mind, because this fund isn't super focused on profits, it's going to be affected by rising interest rates. Not as bad as ARK, but it's not going to be immune. So that's my list of the top growth ETFs to buy and hold for the long term. If you hold onto these funds for the long term, I'm very confident that they will make you a lot of money one day. Now, I'm going to pick a winner, but this really depends on the risk that you're willing to take and what you're looking for. And on top of that, it also depends on if you believe that these actively managed funds, like ARKK, will continue to outperform the market. So if you forced me to pick my top ETF, I would probably go with VUG. Despite it having a lower annual return than some of the other funds on this list, I like the companies that they're buying, I like that it's relatively diversified, and I love the fact that it has extremely low fees. Because of these low fees, you're not relying on a fund manager as much to outperform the market. You're not relying on them as much to make up for the money that they're taking from you. On top of all this, the fund has a very low turnover rate of just 6%. This just means that on average, only 6% of the holdings within the fund are changed on an annual basis. This just means less costs for you as the investor. To make this fund even better, you can pair it up with its sister funds, VOT and VBK. These are exactly the same as VUG, but meant for mid-cap growth and small-cap growth. So the portfolio that I'm talking about would look like 33% VUG large-cap growth, 33% VOT mid-cap growth, and 33% VBK small-cap growth. This portfolio would expose you to the fastest-growing companies of all sizes across the entire United States. If you would like to set up a pie that would auto-invest in this distribution, I've attached an M1 Finance link below. So now if you're looking for more of a high-risk, high-reward investment, I really like OGIG. Mainly because I love the holdings within the fund and the fact that it focuses on revenue growth. Keep in mind, almost everyone has their own opinion on what the top growth ETF is. If there's a growth ETF that you like more than the ones that I chose on this list, go for it. The only tip that I'll give you is try to avoid really high expense ratios. So, thank you guys for watching. Definitely subscribe to my channel. If you have any questions, make sure to ask them below. Thank you guys for watching, and I'll see you next time.
Attention young men and women, subscribe to Travis White's channel. He needs your help to defeat the evil, broke YouTuber depression.